call the meeting of the Finance Committee to order. First order of business is the approval of the minutes from our last meeting. A motion to approve, please. Second. Okay, any comments, questions, discussion on those minutes? Okay, hearing none, I'll ask everybody approve those minutes? Approved? Yes. Approved. John? Okay, great. And Brian, I assume you're approving, I just can't see your hand waving.
I'm approving it.
Thank you. Okay, gonna turn it over to Dana and Stewart from Cook Street to go through the current quarter investment report.
Wonderful, thank you. Can you all see my screen?
Yep.
Okay.
Yeah.
So we just wanted to spend a few minutes giving you a recap of performance for the KICA portfolio that our team at Cook Street and Morgan Stanley manages on your behalf. We'll spend a little bit on the fourth quarter, but focus more of this commentary on the full year 2024 results. We'll keep it short and sweet, but please dive in with any questions and we're happy to go wherever this group takes us. We do have every quarter, we include our market update. It was certainly, I think, a mixed bag in terms of returns for the fourth quarter. So Stuart will give a couple of highlights there. It's always in section 2 of the report that we send over you. And we try and layer those comments on what that meant for your portfolio during the quarter. When you look
Excuse me, Dana?
Yes, please.
Could you increase the size of your, just so we can follow along? It's pretty small on our end. Just up at the top.
I'm sorry. Sorry. Yeah, if I zoom in, is it easier to see there?
Yep, perfect. That's good.
Okay.
Right there. Thank you.
Thanks, Dale. So looking down under the ongoing due diligence section, we just wanted to note that the total portfolio of assets that we manage on your behalf ended the year at just over $26 million. The vast, the majority of those assets, $20 million of those assets are in the reserve fund. So that's where we're kind of focused, that key mandate there, our return commentary. When you look at this portfolio, just a reminder that the target asset allocation for this portfolio is 40% equity, 60% fixed income. And we continue to have those ongoing conversations on targeted asset allocation. And we'd like to continue having those conversations into 2025. This will be an ongoing, make sure this is the right targeted allocation for your team. But we ended the year and we maintain within those approved bands around that 40-60 allocation. And so, we were really close right there, a little bit of cash in the portfolio as of year end. When you look at performance during the fourth
Hey, Dana, let me just make one comment on that. Just recall that what we actually did, yes, it's a target and it's the target range, but the whole objective early on when we reset that was to be able to increase what we had in equities. So if we actually get to 40, great. If it's 39, great. The whole point was that we wanted to be able to have more of the members' assets in equity to drive better long-term return. It's not per se got to get to 40-60 or somebody gets in trouble. That is the target. I just want to make sure that was clear.
And that's a great point, because that's a slight increase from where we started at 35% targeted equity. So it is, in our view, it's kind of a minor increase, but that equity within your portfolio has certainly been driving returns, right? When you look at the returns for this portfolio, yeah, exactly. Like that 40% exposure has been really additive over the last 2 years. So when you look at kind of the overall goal of this portfolio, is really kind of outpacing inflation. And then we use this kind of 3%, and we can talk about whether or not that's the right rate, but you certainly have done that over the last 2 years, and you've done it quite handedly. During the fourth quarter, Performance for the reserve fund was negative. This was the first quarter of the year that we had negative returns, and that's really largely due to what happened in rates and what happened in the markets during the fourth quarter. So Stuart will talk about that. You know, when we look at it, you know, down 1.65% during the quarter, we continue to see this trend of your portfolio protects a little on the downside versus the IPS benchmark, which are these agreed upon, you know, target underlying, you know, asset allocation indexes that we track the portfolio towards. So again, you know, what really happened is even though the Fed continued to reduce rates in the fourth quarter, yields, treasury yields rose quite a bit on underlying economic and inflation data. And, you know, investors became less expectant or less confident of rate cuts, more significant rate cuts in 2025. So you kind of saw that play through in the treasury yield curve, and you saw a pretty big steepening in the treasury yield curve as well. And we'll talk about what that meant more granularly in a moment. When you look across what drove the negative returns, it was really fixed income. So really, you know, when you look at what the positive side of the portfolio, it was the equity exposure that you have there, that 40% equity exposure. I think when you look across performance on the full year, 2024, it's nice to look back and look at the last 12 months. You know, reminder, this portfolio is meant to outpace inflation. You did it pretty handedly, right? During the full year 2024, your reserve fund generated net of fee performance of 7.3%. That slightly underperformed the IPS benchmark, and we can talk about what drove that. But it was really that IPS benchmark, you know, we're really pleased to see that outperformance, and that outperformance was certainly driven by equity exposure and predominantly U.S. equity exposure. So we list the quarterly returns here. Fourth quarter, you know, certainly ended on a more negative note, but it was the only quarter of negative returns during the year. And, you know, overall, we think things are running really well. I think the one big update that we wanted to give you guys a heads up on is that, you know, our team, and we mentioned this when we met last October, began selling those taxable municipal bond positions in early October. Our team paused in the October timeframe and November timeframe because of what was going on with rates and what was going on in the market in general. But we've had close contact and with Sage, the group that's really buying and selling all of those bonds. And they just informed us that last week they were able to complete the sale of all of the remaining taxable municipal bonds within the portfolio. And they feel they were able to do that at a time where, you know, it was not disadvantageous to the portfolio at all. So they thought it was like an opportune time to exit that. So, you know, when we look at this report, you know, next quarter, you will not have any more taxable municipal bond exposure, which I know was a big discussion point last quarter.
Dana, Dana, that's really good news. That's great to hear. Where are they is that taxable? Because it was a pretty large component of the reserve, I thought. Where is that just going to be distributed per your asset allocation between equities and fixed income?
It will actually stay within the fixed income side. It's just going to go more into that portion of fixed income that's meant to outpace the aggregate bond index, right? It's more into a standard portfolio within the fixed income side.
Okay, that sounds good. All right, so no more munis. Thank you. Or
Yeah.
no more of these particular munis.
Yeah, exactly. It still represents part of the opportunity set that we could utilize within the portfolio, but certainly not to the extent that the legacy portfolio had in that particular asset class. And we can report back. I mean, I know that they're working on reallocating those monies across the remaining portions of the portfolio, whether it's in investment grade corporates or other areas of the fixed income market. And we can provide more granular detail the next time we speak around what the composition of that fixed income portfolio looks like on a go-forward basis relative to what it looked like with all those municipal bonds within the portfolio.
Just out of curiosity, like if Sage has it, which I'm sure they do, it'd be interesting to understand where they sold those muni bond positions versus where they were marked at. If that's something maybe just for like the next meeting, or I don't know if you have it on your fingertips, but if not, it'd be great for the next meeting just to understand if we took any type of loss from the mark. I'm assuming they're marked at bid, but if they're not, it would be interesting to. And in either case, it'd be interesting to see where we got them sold off at for next time. Thank you.
Yeah, we're happy.
Sounds great. We'll
Happy to give you
absolutely.
detail.
Before I move on from here, just one thing to note. So 7.3% net of fee returns this year. That's on top of a 2023 full year of return of 8.5%. So certainly the last 2 years, in our view, have been really solid for this portfolio, and again, driven by that equity exposure that sits within it.
To provide some
Really?
additional context there as well, I would say that recall when we last ran an asset allocation study for you all to inform the 40% target itself, recall that the forward-looking expectations at that time were that this portfolio would generate a medium-term return. And think about that as like a 5 to 10-year return of around 6%. So directionally in line with the expectations of 6%, a little bit higher, given that U.S. equities, particularly large cap U.S. equities, have done very well here over the last couple of calendar years, but directionally in line with what our expectations would be given that asset allocation study that was run back in 23.
So moving on to the next page, I'm on page 6, just really quick updates. There's other 2 smaller pools that we manage on your behalf. One is that general fund, the operating account. And this is really meant to be the most liquid, short-term, secure portion, where we work closely with Dale and team on investing those in essentially treasury securities. During the quarter, this bucket generated a net of fee return of 0.97%. And really, you know, what you're going to see is that the treasury yield curve steepened. And so these shorter maturities, these very short-term maturities actually did outperform maturity of slightly longer duration because of the way the yield curve shape changed during the quarter. When you look, you know, performed right in line with where we'd expect given prevailing treasury rates. When you look at the full year for this bucket of money, it was 4.6% return. And then under the designated cash.
Dana, I'll just reference this bucket, and partially for your benefit and for the group, that it's significantly lower than what it has been throughout the year simply because of expenditures and the cash flow process. So now that we're getting a lot of the assessment dollars in, I anticipate transferring a fairly significant amount back to this account.
Hey Dana, just to also clarify, these are all like held to maturity, right? You're buying something and you're just waiting it to mature and then rolling it on to the next T-bill or something along. Okay, yep. Thank you.
And same comment goes for the designated cash fund, Bran, like very similar strategy on the designated cash fund, you know, more money in there right now as of year end, $4.9 million, but that's meant to be, you know, take on very slightly longer duration instead of, you know, under 12 months, we've got up to 24 months in terms of duration, but still very highly secure, very liquid, you know, treasury securities essentially. And up to 24 months. So the goal is to get slightly higher yield. During the quarter, you'll see that returns were slightly lower than the operating fund. And again, that's due to what happened within the yield curve steepening. So, you know, the shorter end of the yield curve actually outperformed and shorter dated securities actually outperformed during the quarter. But when you look at kind of the go forward run rate and you look at where we are, you know, keep in mind this designated cash fund was really set up midway through the year in 2024. So it's really 6 months of returns, and over 6 months of returns, you know, generated about a 2.5% return. So, you annualize that around 5%. That's exactly, where we would expect it to be given where those treasury rates are. So I think, unless there's any questions, we wanted to spend a moment talking about attribution for the reserve fund portfolio.
That last point that you made, Dana, I think is an important one, right? Somebody's gonna, because I know how people's eyes work, right? You look at the bold 4.57, you look at the bold 2.4, and you're like, hey, what the heck? I do think if there's commentary or footnote somewhere, it's worth making the point that the designated cash is just 6 months. And then if it had been annualized, here's what it might be. I mean, I know you made the point out loud, it's on the video, Dave, but.
So maybe if you could make that note to there, and then when I publish it to the website, it'll actually have that
Yeah.
commentary. Does that work?
Absolutely. Yeah. We'll just add and we'll show that maybe more of like a 6-month return instead of showing that it was, we'll make it very clear.
Yeah.
Dana, one thing that you might consider as a useful long-term metric is looking at these returns inception to date. It's one thing to look at it in a quarter. We know there's volatility. One thing to look at it on a year-to-year basis. We know there's volatility. But this is a long-term, on average over time, structure that we created to manage these funds. So an inception to date that we could look at year after year after year after year that gives us, ultimately a 5-year or 10-year look might be something to consider.
That's a great point, Paul. We'll make sure we add that to this executive summary. We do have the details and the supporting pages behind, but I think pulling that up so everyone can see it in the front 2 pages is important to track. For the reserve fund, just so everyone's aware, the inception to date annualized return for your reserve fund is over 7.9%. So, but we'll make sure we highlight that and we can add that to these pages. So thank you. And as you guys review these, and if you have feedback or suggestions, please continue sending them our way, because we want to make sure this summary is really useful for your team and your members.
Since that's a good data point, can you add that for this go around, and I'll publish it?
Yeah,
absolutely. We'll send this over later today with those stats on there.
Perfect.
All right. Well, Stuart, I'm going to turn it over to you to start talking about some attribution.
Yeah, I'll keep my comment brief. I know you guys, I'm sure, have a packed agenda. I'll spend a couple minutes on attribution and just a couple minutes on the markets themselves. We included kind of a calendar year viewpoint on how the portfolio performed relative to the benchmark that we have set out in the IPS. So you can see how it performed over each of the 4 calendar quarters in 24. It was a relatively good year. We underperformed a little bit in calendar Q3. Again, this portfolio, and you'll see this in the attribution here in a minute, was biased to be slightly more conservative than the IPS over the course of the calendar year. And what I mean by that specifically, and you'll see this in a moment, small underweights to our overall equity exposure relative to that 40-60 target. And then within the portfolio itself, being a little bit underweight to US equities, particularly large cap equities, overweight a little bit to small cap, overweight a little bit to international. Again, I don't want to overstate that. We're talking about 1 to 2 percentage points. But if we're looking at attribution here over the last calendar year, the primary differences between the IPS benchmark and then how the portfolio actually performed were driven by those underlying asset allocation differences, knowing that, again, with full year calendar returns running in between 7 and 8%, certainly ahead of the inflation target and ahead of our expectations of this portfolio earning around 6% on an annualized basis. But you can see what that attribution looks like over each of those 4 calendar quarters. We sum that up on slide 8 of the presentation, where you can see, again, looking at it in a different perspective, how we got to that differential between our IPS benchmark and the portfolio's return here over calendar year 24. Again, some negative attribution as it relates to being underweight equity, specifically to large cap US, a little bit overweight to international equity. In the context of where valuations have been, where we're comfortable with that positioning, but it was a slight drag on performance. We made up a fair bit of it with the fact that your underlying managers within the portfolio, particularly Sage on the fixed income side, had a really strong year from a selection perspective. So almost a percentage point of outperformance from Sage alone over the course of this past calendar year. Mixed bag for the underlying equity managers. We had some underperformance of some of the managers in emerging markets. Some other managers did particularly well. On net, it was slightly negative, but again, the returns from Sage and the fixed income side were very positive relative to what we've hired them to do. Again, notwithstanding the legacy muni positions that have been since extricated from the portfolio itself. So just again, some high level commentary in terms of how we performed over calendar year 2024. And again, this will be more meaningful. I mean, to Paul's point, as we get a 3-year track record, as we get a 5-year track record, we can look at longer term time periods and assess how the portfolio is doing relative to various benchmarks that we might set out for it.
Stuart, 2 questions, if I could. You referenced some underperforming managers. Do you have any of those managers on your watch list at this point for potential movement away from their portfolios?
No, not quite yet. Not quite yet. Like if we want to, Dane, if you want to go to slide 29. I would say that, ones that I point to over the course of this past calendar year. Now, again, we can maybe provide some additional details since your all's inception only goes back a year or 2 or so, where we saw underperformance from various managers within the portfolio over the course of calendar year 24. Really, it was 2 managers primarily. It was our small mid-cap manager, Earnest Partners. So you can see fairly significant underperformance for Earnest Partners last year. Now, they outperformed in 23. So they outperformed in calendar year 23. They have a strong track record going back prior to 23 and prior to their inception within your all's portfolio. But it was a bad year in 24 for that manager. It's a relatively conservative strategy, but even with the taking into account the relative conservatism of that portfolio, they had some poor stock selection over the course of the year. So they're getting closer to what we would consider like watch list status. So we want to see performance bounce back. Again, they had a good 23, a poor 24. That was the biggest detractor from a manager perspective over the course of calendar year 2024. We also saw slight underperformance from our emerging markets manager as well relative to the benchmark. But if you look back at that inception to date performance, really strong returns for that manager. They had a really, really good 2023. They underperformed slightly in 24. So nothing that we would rise to the level of watch list. So Earnest Partners we're looking at most closely, but aren't taking any action at this time. And we want to see performance turn around relatively quickly. Otherwise, generally speaking, it was a pretty good year for the managers in the portfolio, particularly on the fixed income side.
Okay, thank you. The second question I have, it's a question, more a comment, looking for your insights and views here. The U.S. large cap market value is so significantly driven by the Magnificent Seven. And if we're underweight equities and underweight large cap equities, then where the highest performing returns happen to sit, then we're always going to be short of the benchmark. So, which doesn't cause me any great consternation, but I'm just curious. You've got 7 large cap equity companies that account for something like a third of the market value of the world, or 30% of the market value of the world. How do you think about that relative to our equity portfolio and the expected returns, and so on?
Yeah, so your point, we thought this was a good visual to include within our market review this year. This looks at the decomposing the return on the S&P 500 over the course of the last calendar year. The return of the S&P 500 is up 25%. That's the third calendar year in 4 years. The S&P is up 25%. I mean, fairly significant returns within that market. But as you referenced, largely driven by just a handful of companies. That Magnificent seven contribution over the course of calendar year 2024 was around 60% of the return of the S&P 500, which we have there highlighted in blue. And the rest, that other 493 or however many folks are in the S&P 500 beyond that seven, contributing only 40% of the return over the course of the last calendar year. It's been a difficult market environment for asset allocators because the S&P 500 has been outperforming most every year here for the last 10 to 15 years, if you look out even over a longer term time period. So it's always been that balance of making sure there's appropriate exposure within the portfolio to those kinds of companies. And we do have appropriate exposure there, but Morgan Stanley's bias, I don't think we're alone in this viewpoint, is valuations for these companies have been stretched for quite a while now. Their earnings have been really, really strong, but even with that said, valuations have been stretched. We even have a page on that on slide 18. If you want to go forward one more, where there's increasing dislocation between the valuations of those companies relative to if we looked at a different way of measuring the S&P 500. In this case, it's a market cap versus an equal weight, which kind of highlights that differential. We've been slightly underweight to large cap US equities given those valuations, but again, only by a couple of percentage points, knowing that we still want that meaningful exposure. We still drive towards those long-term return targets, but biased to be a little bit more conservative and take down some of that exposure, given the valuation considerations. It didn't help us in calendar year 2024, but again, it was relatively minor in terms of its negative attribution, because again, we just want to have that balance of making sure we maintain appropriate level of exposure, but also to acknowledging where valuations are. And it's been helpful so far this calendar quarter. Now I know we're only like 1 month in and maybe we can follow up. I mean, it's been good for this calendar quarter. We've seen a pullback, particularly like in NVIDIA and some of those names here over the last handful of days. But it's still a relatively short time period for some of that pullback. We'll see how the rest of the quarter progresses.
Yeah, so what's the sage little s? What's the sage thinking around DeepSeek and the implications for Magnificent Seven and others? Are you guys, who's working that? What's the thinking?
I think the market's still trying to digest the headline announcement around DeepSeek and really trying to investigate the extent to which it was built that much more cheaply, which is maybe a coarse way of saying it, more inexpensively than some of the models that have been developed in the US that have a significant amount of investor funding. And the ultimate question is if DeepSeek or other models can be built much more inexpensively than some of these other models that are in the US, whether it's OpenAI or Claude or some of these other platforms, what does that mean in terms of long-term spending for technology companies in this area? And how does that impact revenues for companies like NVIDIA? I mean, NVIDIA was down 18% when that announcement came out. I think markets are still trying to do that in investigation of DeepSeek to really understand whether or not that level of funding that they've claimed that they had to develop this model is accurate or not, and what the implications are. So I think the market's still trying to digest it. Again, like heading into this year and over the course of last year, Morgan Stanley as an organization was slightly underweight to companies like this. That was more just overall valuation considerations. I don't think that's changed here in the short term, but I know the market's still trying to digest the extent to which the DeepSeek development is something that could change the forward path of earnings for technology companies here in the US and globally.
Well, I think to me it's very possible, right? Especially if they're using free OpenAI as the back end, right? They essentially built the top on it. And OpenAI is open. So I think it is going to fundamentally restructure the way the tech companies do stuff, and it's going to fundamentally restructure the revenue that they can get from their clients. So I don't know. That's definitely a thing that needs to be watched.
Yeah, I mean, if they really were able to bootstrap components from Meta, components from OpenAI, and do it at a fraction of the cost, that has serious implications for technology-related earnings. And for anyone who's had the opportunity to use DeepSeek, and I've spent time myself here over the last week, like spending a good amount of time using it, it is very strong relative to other platforms. So, and you all, and in your previous careers, I'm sure have been aware of this. You know, technology, generally speaking, can be deflationary, like in and of itself. And so the idea that something like this could end up being deflationary versus leading to, really heightened level of cost for underlying companies that use the technology isn't overly surprising given the trajectory of technology over the last 20, 30, 40 years. So yeah, obviously it was an important announcement. Obviously it had a really big impact on NVIDIA and some of these other companies, and there's been a ton of volatility in markets here over the last handful of days, and it'll be interesting to see how it plays out here for the next couple of quarters.
Okay, hey,
I just think this is worth, I mean, I don't know how large a percentage of the portfolio that we have of the 26 million is driven by these entities in this segment. It's just probably worth keeping an eye on over time. You know, these cycles come and go, and yeah, this one's particularly impactful. So we should just keep our eye on it.
Yeah, I would say, and we don't need to turn to the slide, Dana. For your all's benefit, slide 29 of this presentation includes details on the underlying portfolio. Within large cap stocks, we have around a quarter of the overall portfolio. But again, there's a lot of companies in large cap US stocks. I would say that the most meaningful component within those companies are going to come within the passively managed growth ETF that we have in the portfolio that's going to give that beta exposure to those kinds of companies. JP Morgan, which is our active position in large cap growth, which is a really strong performing active manager, will have some exposure, but they're underweight to a number of those companies. And then the remaining portion of our large cap US exposure, those next three line items down, are more in value oriented companies. So think of that as your classic like Procter and Gamble's of the world, or more conservatively managed technology companies like an IBM or something to that effect. So we certainly have like a decent amount of exposure there. It seems like a lot. It's actually underweight, again, like the market cap of the overall US market, which is kind of extraordinary. So yeah, we're staying very close to, those positions and understanding that balance of, again, having exposure, given that's where the earnings are, to be fair, like within the US economy right now, but also knowing that valuations are stretched and have been stretched for a while. Only other comments on the last like 3 months, just to wrap up. I mean, data referenced it, steepening of the yield curve negatively impacted fixed income markets fairly significantly. The only other thing I would say is as the yield curve steepened following the election, the US dollar strengthened significantly as well. So for US domiciled investors, a strengthening dollar is bad for market returns because those foreign dollars are translated back at rates that have depreciated, which means more. It wasn't a particularly great quarter for international equities anyway, but it led to a really poor return for that asset class over the quarter because the dollar strengthened in some cases 5 or 10% relative to other major currencies. So underperformance from international markets, again, driven by the strengthening of the US dollar. Those are the other kind of broad trends that we saw here over the last 3 months or so.
So we will update this reporting to add the inception to date returns, and we'll make it very clear that the designated cash portfolio is 6 months of returns, and we'll get that back to you. But and Brand will certainly bring an update on kind of more details on where those municipal bonds were sold during the first quarter during our next meeting. But please let us know if you guys have any other requests or additional feedback. Otherwise, we'll keep staying in close contact with Dale and with your team over the coming quarter.
Great.
It's a really good report. I like it a lot.
I like page 19.
It's informative, yeah, it's well done.
Just kidding. Oh. Okay.
It was good seeing you all.
Thanks a bunch.
Well,
Drop.
Yeah.
Thank you.
Thank
Thank
all.
you.
Yes, sir.
Okay, was it okay to ask questions
It-
on this topic now?
It is. I mean, the way the committee meeting is supposed to work is largely supposed to be observation, but it's just us kids, so. Yeah, go right ahead. There's not, it's supposed to be the committee doing the work, not audience participation in the middle. That's the way they're supposed to work, but it's fine. Yes. Yeah.
I'm a little confused by that, but anyway, I had a couple of questions. First of all, I think Paul's suggestion is a good one in terms of tracking performance inception to date. I would also suggest the very last page of this deck, page 71, shows the producer price index for commodity construction materials, which I guess is close as we can come to what we're really trying to protect here. And that chart on page 71 has a 5-year rolling average, 10-year rolling average for that index. And I think that would be a helpful data point to have in the inception to date metric disclosure. Okay, so the biggest issue or question that I have for the committee is that I think the two most important drivers of the success of this program is what is the allocation between debt and equity, and then within the fixed income, what does the bond ladder look like? How much is 9 months, a year, 5 years, 10 years, 20 years? So is there a formal, and I'm not sure who determines the bond ladder, Dale, do you do, is that something that we do? Who determines that?
They do in conjunction with the IPS and their goals for the
Right.
portfolio.
Right, that's what, essentially, that's what they get paid to do.
So
I think it's
not based on your expectation for expenditures or debt balance in MRR reserve.
It's different for each of the three cash buckets.
Yeah.
Right. The MR&R is based on the expected returns, because it's such long dated liabilities. And they've tried to mirror the fixed income portfolio consistent with the benchmark components of fixed income in the target allocation metrics. The operating and designated CAD is a totally different structure based on your assessment of what those cash flows are, and then the ladders are constructed to try to mirror what that is. And we don't, I'm sure you don't always get it right, but you know, it's sort of.
So for operating, it's all based on my cash flow, and I will tell them what maturities I need based on when I need the cash flow to come back. So I may tell them, hey, 2 million at 3 months, 2 million at 12 months, because I don't anticipate needing it for another length of time. And so they don't manage that portion of it. I do. Designated is a little different in that, for the most part, those dollars are designated long-term because it's name storm, it's the segment, cash balances, which, don't fluctuate that much. And then the asset replacement dollars, which is somewhat fixed.
I guess the point that or the issue that I'm raising here, which I think is going to be relevant to the board decisioning process, because this committee is doing its work, it's going to the board has to, you know, agree whether it's happy or it's unhappy, but the two sort of overarching factors that are going to drive ultimate performance of this portfolio relative to our strategic requirements scale, which you're suggesting, are the allocation between debt and equity, and then the distribution that we see on page 32 of maturity structure. Those are the two big structural drivers of performance. And so my question is the committee suggesting that at least for the current period, for the foreseeable future, the committee is endorsing those structural features, namely allocation between debt and fixed income, and within fixed income, the bond ladder that's reflected on page 32.
Yes,
Okay, so that's something that when the committee comes to the board, those recommendations will be explicit. We endorse this framework.
the board has already endorsed that by virtue of accepting my. Oh, okay.
Yeah,
All right, this is-
can I just interject here? I think you're missing a piece of this, which is, yes, asset allocation is important, and the bond ladder and how we ladder treasuries or whatever we're primary laddering treasury is important, but also like manager selection is important here for Morgan Stanley. So the way the committee is going to judge any of our reserve manager or investment manager, whatever we want to call them, is not just going to be the asset allocation, but also the manager selection. That's a critical component of how we're going to generate, hopefully, alpha in this and how we're going to generate return. Just like the last manager overloaded us in illiquid munis, which is pretty primarily reason they got fired, not because of asset allocation reasons. So security selection or manager selection will be key in performance of these assets.
That's the point of view. And I'm not necessarily disagreeing that it's important, but to me, anyway, my view, for what it's worth, is that the fundamental decision about debt versus equity, and then within fixed income, the distribution between less than 1 year and 10 years, is way more important in terms of how we want to manage the members' resources. And I just want to be clear that either explicitly or implicitly, the board can understand that the finance committee is comfortable with those allocations and is therefore endorsing the allocations based on what we know now.
So the finance committee recommended to the board those allocations, and the board voted and approved those allocations. So the board, unless the board has lost its collective little mind, the board absolutely understands what the board has agreed to, which is the 40-60 split.
Right. Okay, so could you ever imagine a situation where the finance committee says, you know what, 40-60 split isn't the right place to run?
Sure, I think that, I mean, that would be the job.
That's consistently over the last 3 years.
Well, yeah, so I think the whole point I'm making is that it is, I think it's the board's responsibility to say, leave aside manager selection, bias, and all the, you know, alpha. What the board really wants to make sure is that we have the right allocation between fixed income and equity on the one hand, and the maturity structure of our fixed income on the second. So it seems to me it would be helpful to know within the overall construct of the policy that the finance committee is endorsing the allocations that we see in this report. And if you're not, say so. If you are, say so.
Well, can I interject here? We wrote an investment policy statement that was agreed to by the board and that was put forth by the finance committee. that investment policy statement has ranges in it, right? If I'm an investment manager, I do this for a living. You cannot then say, well, we every single day will endorse what you're doing within those ranges. As an investment manager, and would be Cook Street, their job is to manage those ranges. Our job from an investment committee and board is to approve those ranges, not every single day to say, well, we approve your 36% allocation to equity and 64 to fixed income, and next meeting we're going to approve something else. That's oversight and overstepping what we're doing here. You know, we're not involved in the asset allocation. We're, to the extent of day to day, our responsibility is to say what is a reasonable limit for our owners to maximize investments for our owners. And that was set forth in the investment policy statement, which the finance committee put forward, the board agreed to. So I think the bigger question, Paul, is do we agree with the ranges we've set in? But I think personally, you know, as a member of the finance committee, us approving as a particular day's asset allocation of our investment manager, that's not our responsibility.
Well,
You
what
know,
if,
like-
what if there's an opportunity, maybe Paul, what you're asking for is that, I mean, and Brand, you would know, what is the frequency in which the investment policy is reviewed and submitted to the board? Because I mean, if Paul's just looking for validation that we're all still good with the construct of the investment policy, then maybe it's just periodically affirming that. Or if there is a once a year reaffirmation, then maybe that's what Paul's looking for. I can't speak for Paul, but maybe that's the way we work through this, is just there's some review of the investment policy, some assurance that, you know, we're looking at that on a periodic basis and validating the current policy, or, you know, evaluating whether it should be changed. Is that?
I think that makes sense. I think that makes sense. Yeah.
Let me try it again.
I actually don't know what you're asking, Paul.
You what?
I don't know what you're.
That's what I'm trying to clarify.
Go ahead.
So we have ranges, investment ranges that have been embedded in the policy that has been approved. Right?
Yep.
We agree that. We also agree that we've hired Cook Street to help us make decisions about where the allocations are within the policy framework.
No, that's Cook Street's job. They're not helping us do that. They're doing that. That's what we pay them to do.
Oh, okay, but I guess then maybe that's the heart of the issue.
To Brand's point.
It seems to me, and my recollection was that we had agreed that before Cook Street would change the allocation, they would notify Dale.
They notify me on every single transaction.
Yeah.
Right, but more importantly,
Sure.
the allocation within the range. So if they wanted, if they said we should be at 35% now, or we should be, you know, whatever, the staff would know that. Right?
Yep.
Okay, so all I'm saying is that the finance committee is endorsing the current allocation that is recommended by our investment advisor.
Yeah.
That's all I'm suggesting.
Sorry.
And
Well,
Yes.
on an ongoing basis, because the policy is a range, on an ongoing basis, board knows that the finance committee is comfortable with the allocations that are represented in this document, because I think those basic allocations are much more important at the end of the day than whether we're using Morgan Stanley or JP Morgan or XYZ, you know, manager for a particular segment.
Yeah, I would disagree that one is much more important than the other. It is an intertwined set of three. So one is not more important than the other. And to Brand's point, part of the reason that we are with Cook Street is because we dumped the prior. as a result of the actions that they were taking. So it is the job of the finance committee to pay attention, right? That's why we do this quarterly report. That's why we do this quarterly review. So if as a finance committee, we come to a conclusion, who asked the question about, the watch list, right? Those are the questions that we do ask, right? Do you have these guys on a watch list? Stuart's answer was good and clear. That is what we do. So yeah, by virtue of having these meetings and going through the quarterly report, we are in fact saying, yeah, we agree, you people are doing the right.
Okay, and that's, Lisa, that's my only point.
Okay,
That it would be helpful to acknowledge explicitly that oversight is there, and the finance committee agrees with those allocations collected.
okay,
That's all I'm saying.
okay.
I'm not.
Yeah, so I just think I just think there needs to be a little bit more of an explicit report out to the board. I think that's what Paul's saying, right? That we on a quarterly basis, we review the performance of the asset manager and the assets and the asset allocation, and that they're consistent with the investment policy, and we're comfortable with the decision making and the performance of the asset.
So that would be Lisa's report at the next board meeting.
Right.
because
Yeah.
this-
Yeah.
Okay.
That
All right.
to me is kind of solves the
And John, to your earlier point, I think perhaps we should have something where once a year, or if it's needed or more so, that we say, hey, we continue to affirm the investment policy statement. We agree with it, just to be clear. So it's out there.
Yeah,
I
because that's
do like
really
that
what it gets
concept.
down to, right? The point is,
Yeah.
still good with 60-40 or whatever. And then it's like, okay, within the 60-40, the investment manager has leeway and flexibility to maximize returns both on, and it's not just 60-40, to Paul's point, probably ought to have some kind of duration guidance too. And I haven't read the policy recently, so it may be in there. And I just think, whether it's once a year, once every 6 months, there's a validation of the investment policy. And that way people are comfortable that that's being looked at as well.
Yeah, well, it surely wouldn't be every 6 months, and I think.
Yeah,
don't
whatever,
forget the-
they're whatever that's
It's
appropriate.
pretty sure it's in the policy that it takes the periodic and regular review. I don't remember if it says annual or not.
And that is how we got to the most recent update, right?
Exactly.
Because we do that. It is part of the finance committee agenda to do that.
Okay, so thank you. I think we're in violent agreement. So the other quick question I have is a quick one, and that is, what did we pay for investment management services last year?
What's the fee?
I mean, it's a minimum of, I think, $50,000.
Well, the report says it's a minimum of 50. Is that what we paid?
I don't remember if it went beyond that or not, to be honest with you, off the top of my head.
Okay, well, that would be helpful.
And it's based on the, on the bucket as well, right?
It does, but there's a floor.
Yeah, the
Or
floor.
we paid it at least 50.
Okay, so you think it was more than 50? Okay,
It could have been, I don't know for a fact.
okay, it just would be helpful to know at the end of the day, how much did we pay for their service?
Yep.
All right. On to the exciting topic of quarterly financials.
Okay, so I tried to generate this report in as final state as possible in conjunction with the audit and year-end analysis, all the above. The audit is very close from a numbers perspective. I think it's substantially complete, but it's not finalized. But I think this report captures everything to date. I think it's fairly self-explanatory, but I'm not gonna go into detail, but I'll just point out a few things, and then, we can obviously work on questions. Can you bring up the report? Should be,
So the forecast.
no, actually, I don't have it on that list. Sorry. Okay. There's copies here if you need it, but I thought I had.
So just as a brief, the
Yeah.
forecast by, it is the end of January, so that's pretty good. I'm on like 3 other boards.
Well, it's a quick turnaround. Yeah, I mean, it's a, fine line between starting it early so that we can get it,
Done.
in the can and to the board when I need to, and making sure that I have all my entries in and invoices and all that kind of stuff accounted for, so. So the cash management page, is, just a standard report that I'll include in my quarterly reports, and that's pretty much a reflection of where we are at any given point with regard to where our cash and investments are. I will point out, with regard to accounts receivable, they're in line, with year end, what I expect for, good balances. We collected all of our, general assessments and flood, with the exception of, 3 liens outstanding as of the end of the year. One of those, we, anticipate, a sale of the home and collection, by the end of January, which is, I guess, today.
Today.
And so we'll have just 2 outstanding. Flood is completely collected because it's set for about $250 worth, so, that's good. With regard to this ensuing year's, collections, we billed, $15.5 million. As of today, we've, collected 8.2, about 50, let's see here.
Let's remind
Yeah,
ourselves.
8.2.
Date, February 6th for,
February
February.
is the due date. We've collected 8.2, 8.3, which is about 53%. And we actually expect, some of our related partners, resort, some of those haven't paid, but we expect those, we're in close contact with them, paying over the next week, which would take that to about 67% collected, which is good performance. Last year at this time, we were about 64%. That's just a reference. Flood mitigation. We are under contract for the completion of the final project. That contract is, and this is all in the report, in the narrative. That contract's for about $698,000, and at the end of all this, we expect about $574,000 to be left unspent. That will sit on the deferred revenue side on the balance sheet until we have maintenance projects specific to these projects that related to the flood mitigation special assessment, or new projects that the board has approved. This $574,000 will be attributed against those types of projects. On there, we have the fund balances for the various segments. I will note that in the narrative, and again, if you're following along, I had approximately 10,000 being the preserve net fund balance at the end of the year. And that actually is going to approximate 3,000, just because we had a couple late invoices come in that were attributed to that, and I didn't get that put through on the narrative. On the income statement for the operating fund, the contribution to reserves performed really well. In total, $4.9 million against a total budget of $4 million. As you remember, at budget time, we budgeted for that the total revenues to come into the reserve fund, and then we expensed the allocation out to the operating fund. And those operating revenues were recorded under miscellaneous income. I've since reclassified all that so that we record that revenue directly to contribution to reserve in the operating fund. And that's why those variances look a little different in the income statement. In the narrative, I provided a 5-year summary of where we were with contributions to reserve. This was the highest year over the last 5 years before that, primarily because of the Cape coming on board. Next year, our budget is slated for 2.5 million. The next significant development that's coming on board won't occur until 2027.
So,
Mhm.
so not quite half. Between 24 CTR and 25 CTR. So how does that impact the way that you think about moving the money around? Because the level of projects that we've got going on in 25 seems to me to be less than what we had going on in 24.
I don't have the budget in front of me, but yes, but we're still budgeted to have a net surplus in the reserve. Yes. Moving on to the expense side, I just would like to point out that it was a big decision to move towards a self-funded employee benefit plan. That has worked very effectively. The budget, we end up being net of, we did have some savings in the dental, short-term, the other lines, which offset a little bit of an overage compared to budget with regard to the health lines, but the net is about $50,000, which I think is tremendous in the first year of that plan. The reason why we're able to budget that way is because we have an aggregate cap on the claims that we pay, and we reinsured for anything over that. And that's all incorporated into the budget. So,
And I think the reports from the KICA employees and staff are really good with respect to the information that they get through the plan. They're a lot more well-informed now. And they like
we're so much more knowledgeable of what is happening within the claims environment, and we are because of that, we're able to be more proactive with regard to how we manage that, and we're getting prescription credits. That's are fairly significant, 18,000 this last year, and we expect that to be higher next year. So the move from a 30,000-foot view was a very good and effective move, and I think that in the future will allow us to be able to control this area and manage this area much more effectively.
offices with movement.
Just a typo in the operating fund income statement narrative with regard to gains and losses. I actually picked up that I indicate that that's $360,000. It's actually 93,000 for the operating. I picked up the consolidated number for into the operating fund. Just pointing out that typo. If there's questions, I mean, I think that the whole idea of this is to provide a summary of the quarter and provide some level of detail without going too far, so to speak. But if there's questions or clarifications, I'm happy to entertain those.
I think it looks good. Had lost my marked up copy. I'll find it and send it to you. There's one question or something.
And if something
Are you
pops
going to
up,
talk about the reserve funds and reserve income statement separately, or you wouldn't wanting questions for everything at this point?
I'm happy to take any questions. If you
It's
have
not, it's basic consistent with the email I sent out yesterday. It's just, the CTR is going down, from 4.9 to 2.5. If you have completely eliminated the 15% of CTR from the operating fund, it's like $130 per member, at 5,400 members. So the impact of a reduction in CTR due to lower real estate sales, on the operating fund isn't necessarily that impactful. But when you look at the potential on the reserve fund, I guess it could be, right? And like you said, we don't have the budget, but the CTR on the reserve fund income statement was 4.2 for this year, and I assume we were budgeting 2.5. I know you just got asked the question about whether we'll still have an operating surplus. But it, the question just becomes at some point, if 2.5 becomes the run rate, and I don't know what 27 looks like, depending on what other things, I just feel like still there's some uncertainty in my mind anyway, as to the composition of revenues going forward as the real estate, which is dependent to some extent on real estate activity, right? So, if we look at historical on page 10, if you look at the historical CTR revenues, it's, clearly far higher than 2.5. And the question really is 2.5 the new run rate? And how much visibility can we have, recognizing that, real estate activity is variable, right? So it's not like something we can definitively look at. The question is, should we do some scenario analysis that says, base case, this is kind of what we think real estate sales are going to be, real estate activity is going to be, and therefore this is kind of what we can expect over the next 5 years our CTR revenues are going to be. And then we kind of, we kind of stress it and say, if it's better, it looks like this. If it's worse, it looks like that. And that way we just have some sense of kind of what that looks like, because it's a pretty significant number, at least as it relates to the reserve fund revenues.
So as part of the budget process, I produced, and we reviewed it on a couple of occasions, a 10-year analysis, which included.
Okay, great. I mean, if that's
the revenue projections.
Yeah.
And, in the long run, beyond the new developments coming in 27, 28, what I try to do is a conservative approach so that we can at least have our bases covered, so to speak. So I think I took it down to $2 million after 2028. And, if that fluctuates 500,000 here or there, it's not that big of an impact. But that 10-year analysis does exactly what you're talking about. With these reserve study expenditures, projected expenditures being the expenditure side, right? So then that resulted in what we believe to be the reserve fund balance each year and where we stand. So that picture, I think, is painted, so to speak.
Great. Could I get that?
Asking whether you did share that as part of the budget documents.
I mean, it was in our finance committee meetings. I think I shared it in board meetings.
Okay,
Sure.
sorry, I missed it.
Just let me know.
Okay, I'll go look for it.
Good.
I think so,
great.
yeah. All right. Very exciting financial controls manual.
Okay, so just a quick review of the process. There's a subcommittee that's Debbie, Michael, Dave, and myself. We distributed a red line of the SCM, which I put together, and as well the accounting department standard operating procedures. In the one meeting we had, we reviewed the substantive topics. We didn't go through in detail wording, housekeeping, all that, because I think there's a few things that we wanted to address from and can you put up? No, if you can put up number 5, I think. It's what grade? Number 5 on the 5.
This is fine.
All right, well, can you go back to it's the 3. It's not, we didn't want to go through all the details, but address the important topics on the front end. And then I anticipate that we would present these here today and then discuss them, give orientation and direction. Subcommittee would meet again and produce a detailed red line that then would come back to the finance committee. We'd provide that to the finance committee in advance and then go through that in detail.
Everybody had a chance to look at the current version, your red line version, because I think there's good stuff in there, and these are the subject of discussion.
The finance committee, I believe, is
Oh, it just went to you, just sent it to me.
yeah,
Okay, cool.
as a copy,
Good.
be a part of the subcommittee.
Perfect.
And just to note, there is not a finance committee meeting scheduled in February.
Correct.
And then March is audit presentation, April is insurance, and May is typically the review study. So
If we got our act together,
depending on how you want to do this, that may be something we
right,
consider.
I agree. If we, if we get through this, get the comments, subcommittee meets, not inconceivable, we could schedule a finance committee meeting in
Okay.
February.
That's,
I'm okay with that.
can you increase that budget? So topics, first one was internal controls. What I did with the financial controls manual, and I think it's Michael and Dave, please, this is not my show. If you have thoughts or comments along the way that I welcome your participation in this. I'm just delivering kind of a recap, and then we can talk about each of the areas as we get through them.
I think you only got my.
No problem. Is it gonna be, are you projecting it? It's
Yeah,
not showing
she's-
up on the screen.
Okay, she's starting. So internal controls, I added, and just, this is not that we need to discuss or really discuss it in detail. I added a bit of finance committee oversight to the internal control environment. And I also added, based on input from the subcommittee, an external audit overview section, so that at least we kind of paint the picture of what is involved with the internal control environment within the financial controls manual. And the thought process, there's been discussion and comment at various levels with regard to internal audit or an external internal control audit. And I thought that it was important for the finance committee to review the landscape first, understand what internal controls are in place, and then basically make a determination and a recommendation to the board as to what the finance committee believes should or should not be done.
It is, to me, one of the things we want to have rationalization. Two things we want to have rationalization between is what's in the financial controls manual at a high level with respect to internal controls and the SOPs.
Exactly.
Every item in the FCM with respect to internal controls should have detailed representation in the SOPs.
Yeah.
And it may be that we've got some SOPs in place now that we don't have listed as part of internal control.
Yeah.
So to me, that rationalization, making sure we've got a complete set, high level in the FCM, detail in the SOPs, structurally as well.
Can I ask a quick, oh, sorry, Lisa.
I'm done.
I was gonna just ask a quick question here. So is there a debate to have an internal audit done? Did I
No.
misunderstand that?
Again, to be honest with you, I think there's just been comment and or discussion. And in speaking with Kevin, our chair, board chair, I think it's important for the finance committee to review this area and then put those comments or questions in perspective and to some level of conclusion, whether it's what steps are necessary or not necessary, or maybe what's in place is perfectly fine and we're off and running.
Yeah.
Okay, thank you very much. Thanks.
But I think isn't part of the annual audit process to review the internal controls? Maybe not a full report, but they do review internal controls. That's how they're going to audit anyways.
Right, so again, that's part of the landscape, and I've added that external audit
Yep.
section to the financial controls manual. And we've tried to delineate some of that process in there so that readers of the financial controls manual will understand what's actually in place.
Right, so to the extent, the extent to which the external auditors conduct a review of internal controls, they do, whatever that is, they do. The question could be, geez, why don't we, on a one-off basis, pay them to take a comprehensive look? We could do that.
And I've looked at that with them and gotten different levels of quote, so to speak. And, it's anywhere from $15,000 to $30,000, depending on the scope of and my orientation is, first, finance committee understands what's in place.
Yeah.
and then, discerns whether spending $15,000-$30,000 is a worthwhile process.
Okay, I agree. So I think that is what we should do. So, update this language that you've done, and then look at it at the full finance committee. And subsequently decide whether we think, in addition, we ought to pay the Forbes gang to do a review and get some recommendations. I think that's a very reasonable approach.
And I just had
Okay.
one more quick question. Have we ever done this type of deep dive? Has an auditor ever done this type of deep dive on our internal controls?
3 years.
Yeah.
Okay,
I think
thank you.
that's seemingly unlikely.
Yeah,
So, Dale, does this language, satisfy the debate that we always have around internal control? About what is the scope of this labeled internal control? Because the auditors don't look at every internal
Correct.
control, they only look at the internal controls. I'm not an auditor, so I won't get the language right, but as it relates to, you know, preparing the financial statements of the entity. But this point number one, does it clearly define what the scope of internal controls are as it is governed by the financial controls manual? Or does it leave it continuously vague as it always has been?
Well, I'll read it again with that comment, but I think it does.
Okay.
It does, but, and I think answering the first part of your question, the answer is unequivocally no, right? You know that we're never going to be able to satisfy them, which is why I suggest that once we finish the finance committee, we as a finance committee decide whether we think it's sufficient, and then we decide whether or not it's worth spending 15 or 30 grand with 4 of us to do a deep dive.
Yeah. Okay, next topic was annual budget process. And again, this is just for reference to give you a heads up on kind of the direction that I and the subcommittee have considered. The current FCM is very detailed and constricting. It stipulates what's to be done in September, what's to be done in October, that type of thing. And the update is less specific, but guided and approved by the board with minimum requirements stipulated. And again, we'll review that later, but it's more taking the experience of the prior year, presenting it to the board in their initial meeting in March, and then in their workshop and saying, this is the plan we want for the upcoming year, and executing on that, rather than in a static document dictating the process when it could change from year to year, and ultimately the board should guide that process.
Philosophically, 100% aligned.
Okay, cash management section, just a heads up, but again, this is all part of the finance committee understanding what we have in place in the first place. We implemented in November a cash management expenditure platform called PaperSafe. It's an automated workflow to provide a non-circumventable process for reviews and approvals of at the appropriate levels, which are consistent with the current FCM, and leaves an audit trail that culminates in payment. Okay, so with that implementation, I felt that we needed to change the procedures with regard to check signing, for example.
But that would be an SOP.
We have an SOP which
That's what paper safe.
that reflects PaperSafe, but as a heads up to this group, that approval process is embedded in the platform. So basically what we're doing is ultimately changing check signers from, up to $10,000, it's 1 signature. Over 10,000, it's 2, and we still have 2 approvers on all expenditures exceeding 1,000. So I have 2 kind of questions to the group, meaning what's the threshold for 2 approvers? $1,000.
Is it cumbersome now?
To a certain extent, yes. But it's doable, we manage it, right? And it's more about a comfort level of the association, the board, finance committee, whether that's 2,500, whether that's 5,000.
I wouldn't change it. I mean, one guy.
That's why we left it at 1,000 for the red one, so.
The optics of changing it to 5,000 or 2,500, somebody's gonna say, why'd you do that? What are you hiding? And it's just not worth
I agree. Then the other threshold of 10,000, again, I can't remember if it was Dave, Michael, you know, we talked about it being somewhat higher, but then for the same purpose, we're like, you know what, if it's not that much of a burden, let's gravitate towards 10,000 and we'll move forward.
I just leave it.
And then we can see how that operates over time, and if next year, 2 years, those need to be adjusted, then they can be adjusted. Any thoughts, guys?
I think that makes sense. And if you're generating a paper trail through this new process, it'll be easy enough to see the distribution, how many checks do you have that are over 10,000, over 1,000, how big a burden is to some extent.
And quite frankly, a lot of what we're doing in accounting is getting with the times, so to speak. This seems to be pretty standard or elementary. And we, to date, prior to implementation, we had stacks and stacks of paper, and this eliminates all that. But yet maintains all that in very secure, backed up databases.
And I think the other thing to think about too, and I apologize for my voice, guys. I just had a procedure yesterday and I'm still recovering a little bit. So 1 and 3 together may make a good point. So maybe in 2025, we would have, or 2026, an internal controls review over how we're dealing with the new platform and how that is working within our system.
Well, and it just jogged a memory too, within that internal control environment, in the new version, so to speak. I actually have a process whereby any substantive change in internal control environment, whether it's an SOP or what have you, is brought to the finance committee for review and comment.
How do you,
Right? So,
I see this one coming too. So then how do you define something?
yeah, well, we can change that, but
Well, I don't know.
I'm not sure how exactly it's written in the document, but it's not meant to be, well, we just tweak it a little bit here. It's just
Totally get it.
Yep. Okay.
One thought that occurred to me, and it's probably a broader board question though, as we go to more of these platforms that we should be doing, we really need to have, the board should have a better understanding of IT security, because now that that's all in the platform, it's very easy for some bad actor to backdoor their way and you know, put 2 approvals and generate a jacket.
We now have a user rights SOP, because that's what you're alluding to, which in our thought process addresses that, and we're actually having the auditors review that as well, because
That's right.
it's wasn't necessarily implemented for the audit per se, because it came so late in the year, but it will be for next year, so we're getting their input on the front end to make sure that anything that needs tweaking, we can tweak.
Which is great, and what that does for you is protect against bad acts of people in the ecosystem. What it doesn't necessarily do, or doesn't do, is protect invasion penetration by people not in the organization.
Right.
And for me, a broader look at IT security is probably part of it.
Well, and Lisa,
Nothing to do with you.
Right.
and I agree with you. Maybe that's the other piece we have to think about is a penetration analysis of our systems every so often.
Exactly.
Because certainly we can deal with internal controls and, you know, who has passwords to do all of these things with, you know, the system. We also need to make sure the system is not hackable.
And
We know when it gets hacked.
and we have a third party vendor that we contract with that assesses that risk.
Yeah. So I do think, and as you all think about, when we have the discussion about insurance and re-up on the cyber insurance, I think the whole cybersecurity realm probably requires, to my point, a serious hard look. And I don't know if it's in the.
So-
CM or I don't.
Probably not, but honestly, can't remember, it was last year or 2 years ago. Part and parcel to our cyber insurance, policy and, underwriter, we did a very thorough, and they require a very thorough audit, so to speak. And Canty helped us with that, and we implemented a lot of stuff
Okay, all right, okay.
as a result. Okay. Another key area was key contract bid process. The old FCM had statements like generally required every 3 years. And this pertains to the key contracts like insurance, investment advisor, health benefits, there's 5 or 6.
Yep.
And they're listed in the FCM. Generally required every 3 years, exceptions permitted with CO approval in no case beyond 5 years. And the group felt that better language might say similarly, but recommended every 3 years, informed board of contract relationships, anticipated to go over the 3 years. Relationships beyond 5 years must have prior approval of the board. Rather than making blank, hard statements in no case over 5 years. I mean, there may be a case where the board says, you know what, this is necessary, we'll go. So anyway, it's for reference. We can talk about it.
I'm not buying it.
And if we get to the red line and the finance committee discusses it,
Okay.
we can change the wording as deemed fit.
Okay.
Now, the big probably discussion point is the asset replacement dollars. Formerly funded depreciation. We'd like to move in the direction of the asset replacement dollar nomenclature. First and foremost, I think it's important to discuss the philosophy and the merit of the process. It's very similar, if not exactly the same premises as the reserve fund process with regard to long-lived infrastructure type assets. The reserve, right, so the reserve fund is exactly that, long-lived assets. What's not covered within the reserve fund are those assets like trucks, equipment, you know, with useful lives 7 years or below. So what this process does is while we add an asset to the system, we depreciate that, and each month that we depreciate it, we fund that depreciation, segregate funds into the property fund, and that accumulates as assets depreciate. What also goes into this fund is earnings on investments related to the portion share of the property fund's attributed cash balance. Okay. What also is included in there is its proportionate share of reserve fund earnings, which I'm not sure is broadly known.
Yeah.
But it's, I believe, the impetus of that was when this, and I'm not saying this as a matter of fact, but I surmise that when the fund started, this process started, I think maybe the idea was that reserve fund could help fund that property fund to get it going. I don't know.
I think it's not worth trying to articulate what somebody might have thought when. I think that this is not appropriate. Right?
Okay, so what the new policy stipulates, the finance controls manual, again, assuming that the process has merit and it makes sense, would be to the two changes would be to eliminate the earnings from the reserve fund, but continue to,
Eliminate the earnings coming into this fund.
exactly. But continue to, attribute earnings from the operating fund that in its proportionate share to help, for the exact same reason, the reserve fund, to help offset inflation. And when there's an asset that is replacing let's say a fully depreciated and funded asset, we don't limit the funding of the new asset to the accumulated depreciation or the funding amount.
Right.
Because we're putting inflationary funding into the account. Therefore, if it costs $2,000 more for this new asset, we should be funding the full cost of that asset.
Right, we're not gonna replace a truck with a half a truck.
What we've done to date is we just use, if it's $5,000 in the fund, the accumulated depreciation, and it costs $8,000, well, $3,000 comes from the operating fund and $5,000 comes from the property.
Right, and it's not to say that at some point in time, you won't have to do that.
Right.
And I think it makes a lot of sense for those earnings.
Can you go to the next scroll up, please? The other way.
Yeah.
Yeah. That's the current status of the fund. So total accumulated depreciation as of 12/31 is the 3.2. 900 and some thousand of that is related to buildings. So that's covered in the reserve fund and we haven't funded those dollars. So what asset replacement dollars in the fund right now is that 2.3, and the funding available, which is the cash attributed balance within the property fund, is 2.9, meaning 600,000 currently in theory can be attributed to, the inflation component. Now, I would tell you that the fund had such an accelerated growth, primarily because of the reserve fund contribution, which isn't, we determined today that's.
I don't think it's a problem,
No.
but that's, once we put this out there, then we'll have a more fulsome discussion.
Right.
Yeah.
So for today, our thought was have this discussion, first and foremost, the merit of the process. Once that's determined, then the actual policy that the subcommittee is putting forward.
Right, I think the whole notion of funded depreciation, we agree, is over, right? We're actually gonna talk about it in this context as asset replacement.
Yeah. Same philosophy, but different nomenclature.
Right. Yeah, I mean, again, we'll put this out there for the finance committee to review. And I think these are the good, big topics.
Are you looking for?
I'm looking for input now to say.
Yeah.
Finance committee. Are we moving forward with this concept? If not, then, because there's been discussion as to, maybe not to the full merit of the process, but the dollar, amount that's carried in it,
So I think those are two separate things. Right?
if we determine the merit.
I think it's a meritorious thing.
Sorry,
The subcommittee,
I'm a little confused here. When you say it is American, what is it in that statement?
Having an asset
Having-
replacement fund,
Which we have today, we just call it something different.
correct.
So,
It's been a hard work.
nomenclature you want, doesn't really matter.
Yeah.
So now the question is, do we want to have a group of assets that we depreciate over time? We could say, no, we want to expense them over time. And just build it into the operating, plan. That probably doesn't meet generally accepted accounting principles, correct? But, so we have a group of assets that we depreciate over a period of time. And I guess you guys can debate whether it's 7 or 5, whether it's different for different assets, whatever. Is the real question you're asking, how does that get funded from a cash point of view?
it's not anything to do with depreciating assets. The question is all about the funding of those depreciated assets
To replace them.
to replace.
So you're really asking a question about the cash, where does the cash come from on average over time basis to buy those new trucks?
Right, so it's anticipated, so it's very similar to the reserve fund in that, one, it's in theory,
You've got an asset.
using the current membership to account for the depreciation of those assets, rather than pushing it off to the future.
Use it,
And
use it.
I mean, the reason I'm asking the question is, all cash is fungible.
Yeah.
So the cash that supports those assets today comes from an allocation of an assessment from members that is part of, I guess, not the operating assessment, but the MRR, the CPR, the portfolio. There's some economics in the portfolio that come over. A more simple way to do it is just to say the annual assessment that we charge customers funds everything in the P&L, of which the depreciation amount is in the P&L. And so the funding for it just comes out of the general assessment. And not try to do all this machination of moving stuff over. And you're trying to account for inflation seems a little odd to me, because based on your capital plan, what trucks need to be replaced in 2025.
So I think about this as, if you think of MR, the current MR&R as major repair and replacement, this is MR&R sub 1, this is minor repair and replacement. So this is a category of stuff that is going to expire sometime between 0 and 7 years. We just take that in that IPS. And you're right, you could just leave all the money in the operating, the general fund. I think having this separate as a minor repair and replacement with a separate IPS is probably a good thing.
Yeah, I don't disagree. I wouldn't overcomplicate it.
Agreed.
And somehow trying to account for inflation and allocating just seems to me
Right.
to be, a complication that the materiality doesn't warrant.
Agreed. And I think part of that happened because what we were doing was funding the depreciation, as odd a concept as that is, funding the depreciation and then getting to the point where, geez, the thing needs to be replaced, and there's a gap between what has been funded through funded depreciation and what's actually going to cost. Attribute that to inflation, how do we cover inflation?
So I think what I'm hearing is you're just saying right now we are pay as you go. And obviously depreciation is non-cash. So we're creating assessments based on, what the budget says. And there's always going to be, if we're basing it on a non-cash basis, then, depreciation comes into play. But as I understand it today, we're pay as you go for any replacement of depreciated assets on the operating fund balance sheet. Is that correct? It's basically pay as you go. I mean, in other words, we know what we have to replace or whatever, and that's just coming out of the operating budget. There's no reserve fund for replacement of assets on the balance sheet. Is that correct?
No, there is, that's the
It's
whole.
partially correct.
That's just profit. There's $2.9 million set aside for replacing assets.
That's actual real, the 2.9 is actual real money.
And it's sitting in a separate account for asset replacement.
That's part of the designated cash fund.
Right.
That was the IPS that we created over the course of this year and prior year, I don't know.
Last year.
Okay, yeah, so there's actual real money. This is an interesting thing. There's actual real money. If properly invested, I guess you might argue that, it'd be interesting to know whether you could argue that if properly invested, you don't need additional assessments, to fund this, asset replacement fund.
Well, it's invested in a designated cash earning basically 5%. We just heard that.
Right.
So as long as that 5% is greater than the inflation amount, you should theoretically have enough
Right.
Cash. I just think, you know, it's all buried in the P and L. It has funding that is year to year based on the assessments.
Yep.
You know, yes, if the truck depreciates over 7 years for accounting purposes, you know whether you're gonna replace that truck in 2025 or not. When you do your capital budget for 2025 and say, I gotta replace the truck, you generally know what the cost is. And you can, if you find yourself a little bit short or a little bit over, you just fund it out of the, you know, the general assessments.
Right.
It's not gonna be material. You need-
Item by item. And maybe that's the point, maybe that's the thing, that when there's a delta, maybe that is what gets stated, right? If there's a delta, then it comes out of the general fund.
And by the way, you know, that truck may be, you know, maybe high performing, you don't need to replace it at the end of 7 years.
There's plenty of assets that we keep beyond the
And,
useful life.
and I mean, this is a little bit the way I feel about MR&R. We're not boxed into a decision based on accounting. We can make whatever decisions we want in terms of, do we accelerate asset replacement or do we delay asset replacement?
And you don't
We do
necessarily.
that.
Yeah,
Yeah.
and so the whole machination that you go through to move cash around is probably somewhat divorced from reality of how those decisions are made.
Right, because you could make a completely
Keep it
different
simple.
decision. You could decide, you know, if half the sandcastle blows away, you could just make a completely different decision to not rebuild it and do something else. You're not,
Can I-
locked- we're
can
not
I-
locked.
Well, yeah. That's
I'd be
Go ahead.
curious what the actual experience is, just to dig in a little more with what Paul's saying there. What is the actual experience? Like, if this is primarily our vehicles, is it a 7-year asset, or is it actually, I don't know if we have the data, but I'm just curious. Or is it a 10-year asset?
Vehicles we typically depreciate over 5 years.
Okay, but then the vehicles are not gone in 5 years, right? Or are they gone?
Some we keep 8, some we 10, some deteriorate faster and we do it 5 or 6.
Yeah.
It depends on the use. Yeah, again, I think it's all good conversation. The premise comes back to, do we want to operate similarly with these assets as we do for the reserve fund, and kind of level out
Right.
the special assessment, so to speak. And not necessarily look like 1 year we may have $200,000-300,000 in capital purchases, and another year we might have 50. Do we want that to be borne by the current year's assessment process? Or do we want to have that borne by the fact that we have a fund that will?
And a strategy. Yeah, to me, I mean, logically, it makes sense, right? We've got this big fund taking care of major stuff. And then we've got a smaller fund taking care of stuff that's gonna live up to 7 years or whatever. To me, just logically it makes sense. But I'm open.
I mean, having an account with cash in it to support the asset replacement makes sense to me. This is ultimately is a liability to the members, and they want to ensure that there's sufficient money to meet those liabilities. So that philosophically makes sense. The question is, how do you operationalize that? And I guess I don't personally have a view on that. I'm sure there's best practices out there. I would just try to do it in a way which is effective but simple.
Yeah.
So you're not complicating the work that it takes to.
From an accounting perspective?
From a cash management point of view, from the accounting point of view, it's $2.3 million of liability.
For whatever it's worth, I have my head around this process. And I think it's pretty straightforward, and the process that we discussed at the subcommittee level and now, I think is very manageable and straightforward.
Okay. I trust your collective judgments.
Was I know this is out of order, but just a question, Dale. If I understand you right, the earnings for the MRR were being put into this account.
Yeah.
So I guess my observation is, if that's the case, I guess I would have expected to see a bigger cushion, what you call available for inflation. I mean, these are looking at.
Well, it's a portion of the share, so the balance in here is, you know, let's say over the last whatever number of years, it's been 2 to 2.5.
So 2 out of.
They're only getting 2.5 out of.
But the other thing is, I know you talk about having a level of a better expectation around, you know, what assessments would be. I think this is based to that. Because, you know, one thing called your long aspect to move them around. Here, if you have lumpiness and trucks should be replaced. And again, I'm assuming that when you look at replacement of one truck compared to the new truck compared to what it was before, is probably a significant. You know, it's go by and well.
Yep.
Oh, yeah.
Can I just come back to the MR, the transfer? So this money is not part of the MR in our investment fund,
Correct.
Correct.
but we're taking economics out of the MRR investment fund to fund the inflationary nature of this.
No.
I don't know whether it was intended for inflationary, whatever.
It's just a fact.
It was just a fact. We are taking
Well,
a
that doesn't
portion
make
share of earnings.
sense to me because we have, yeah.
And the nature of the reserve fund is such that it's dedicated solely for the purpose of the reserve fund.
Right.
And this is outside of that, so it's contradictory.
Yeah, that makes.
So that comes, that's,
Yeah, that's a good,
And,
that's a good finding, that should be, in my view.
yes,
and further to that, later, there's a proportionate share, albeit much smaller, that goes to the V-Gate fund. And in this new version, that's being eliminated as well.
Yeah, we need to have integrity, vertical integrity in all of these
Yeah.
fund management programs.
and this would be governed, this is part of, remember, this designated cash.
Yeah.
So it's governed by that IPS at
Right.
least at the moment.
Yeah, and so that's the vertical integrity we need to have, yeah.
Yeah.
Okay.
So it's also a good example of how a better internal control environment will help.
Yeah. I'd say the procedures being followed are exactly the procedures that were dictated and directed. So I take exception to the better internal control environment because
Control, it's a policy decision that we say.
Right.
That needs to be rethought.
and that's the purpose of having this group review the internal controls. So they actually know what the internal controls are. Because to date, I don't believe anybody knows what those are except for
Right,
potentially me.
right. Yeah, exactly. Okay, all right, next.
Okay.
Next,
ARB.
yeah, so simply added the ARB section, which can go over later. It's more of a placeholder because
We don't know what it's gonna say.
once the strategic plan for the ARB is finalized, then we can take excerpts and kind of glean
Well-
what this section needs to look like.
Yeah, and we have to see what happens with the voting.
Right.
Yeah, assuming we ever get there, you know, my pet on this one is, for what it's worth, it should be a separate line item assessment. Members should understand what they're paying in their schedule for the ARB. It should be a separate call out. Whatever we decide, you know, if we decide it's gonna cost us 700 grand a year or $1.7 million, that assessment should be separate, should be a separate assessment, not just bundled into the general assessment.
And that's a much broader conversation with the board and
Okay.
implementation of the strategic plan. and all that.
Yep,
And then the investment section, I added a fairly large section that just summarizes the framework that we've established with the 3 buckets. And again, I stipulate here the reserve fund investments. I stipulated here that the earnings on the reserve fund investments shall be dedicated to the reserve fund and shall not be utilized to fund other funds.
Right.
V-Gate property, etc.
yeah. Where is that section?
It's in the investment section.
So I was thinking about the table of contents.
Mhm.
There may be some, I guess it's probably too much of a pain in the, but to do that, it seemed to me that there were some things that might be reordered.
Yeah, and I haven't touched the
Yeah.
table of contents because I didn't know how all this discussion would
Yeah.
go, and I figured I'd do that at the end.
Okay, to me, this is one of those things, if people are gonna read, this one belongs up front.
Gotcha. That's what I have for today, and again, my thought is subcommittee reconvene, bring back a full red line
Right.
to the group in materials in advance, so that then the meeting becomes a discussion of
Right.
content.
So,
It would be helpful when you distribute that, if you distribute this document we've been looking at
Sure.
as well, just kind of to remind us where.
Yeah, there's a lot of housekeeping type things that,
I think to keep us
Yep.
focused on the big picture items, that would be
Yep.
helpful.
and for the subcommittee, which, by the way, I did all the talking, but it was a really good. Dave, Debbie, and Michael, they gave a lot of really good perspective and input into this process, so it was a very worthwhile, meeting. But I highlighted the key, updates of substantive, and I can do the same thing when I bring it to you.
any, interest in trying to schedule a meeting in February? Maybe, Ellen, will you poll the crowd subsequently? Let's just, either the 20th or the 27th. It's strictly for this. We could call it
Yeah,
a meeting for,
I don't know that we'll get this moved forward very quickly if we don't have a meeting in February.
right, exactly, right. This, what you've heard here won't take you long to clean up.
No,
Right. So I think having a special meeting just devoted to the FCM would be good.
I think you've got a meeting on the calendar in February.
We do?
I didn't see it.
The date. Doesn't matter.
No, I've got the approved meeting schedule from the very beginning of last year. There's no February date.
Yeah, we definitely, I don't think we have February date. But the 20th.
I can do the 27th, I can't do the 20th.
Okay, 20, use poll for 27.
But I'm just one person.
Okay,
Well, maybe poll for the 20th or 27th. Just
sure. See what we get.
I mean, is there anything magical about the Thursday?
No,
that's true, good point.
nothing magical about a Thursday.
Anyway, this is important.
So those
to
2
get
weeks.
done.
All right,
I think we've committed to getting it done. If you need time from the committee in February, we should find the time when everybody can do it. And
I
get it done.
And I think good
let's
participation
figure
would be
that out.
critical.
Include the 20th.
Yeah,
And obviously this needs to go to the board. Is your objective to get it on the March board?
It's all dependent on the process.
That's the annual meeting, and this is never gonna get.
well, there's a March board meeting and then there's the annual meeting. The March board meeting is the 17th.
So I left that up to the process in that, depending on what happens in February, we could slate it for the March board meeting, and if it's ready, then by all means.
Yeah, I guess I would, let's try to get it done in February, and then it's available to the board whenever they have
17th.
time
Monday, the 17th
of March.
of March is the board meeting. The annual meeting is Thursday, the
But if we
20th
can't do it in March, we'll do it in April, but it's
Yeah.
off our plate.
Right.
Off your plate.
in February.
in February.
I think that's a good point. So I think not that it necessarily, it doesn't matter. So I can do 17, 18, 20. 25, 27.
Why don't we do this all?
Yeah, I'm just, now,
So we're not taking. the-
yeah, no, totally agree. But I can at least make those 6 work.
Go ahead.
Great.
Okay, anybody,
Yeah,
anything
good,
else?
good job to the subcommittee. I know, we know how tedious this can be.
That was great. It was a good conversation.
I think the last rewrite was me, Brand, and Jeff Porter.
Yeah.
Yeah,
Which was 3 years ago?
I don't know, Brand, when was it? It was at least 3.
It was 3 years ago, yeah. A long time ago.
In it, that requires a.
A relook,
review
exactly.
Every couple of years,
3.
yeah.
And not more than.
A couple of questions, looking at
Sure.
So, you know, talking with another board member, you know, and I was expressing concern about whether or not we have sufficient liquidity as an organization to deal with the storm. And, you know, the question came up is whether or not the depreciation reserve is a reserve that can't be touched. I think the MRR, people say you can't use that for anything other than that. But the question came up as to whether or not the depreciation reserve is in the similar category for the applications. Like I said, I don't know if you talked about whether or not the depreciation reserve could be used for any purpose other than what is it?
Well, it includes, so the name storm, what's the name storm?
$1 million.
$1 million. So we've got the name storm fund to deal with end zone.
More than $1 million.
Yes,
I guess the question is, could that account be used to?
It's
fund-
not a covenant. It is a policy,
Right.
and board can change without a vote of the members, or can change policy.
And again, my concern is, and again, we are from North Carolina, we did this, how bad it was here, but I don't think it's that bad here.
it was not.
Yeah, and,
We had cleanup,
yeah.
but it did come out.
But again, we would want the island to be able to return to normal, be as beautiful as it is right now, but we wouldn't want it to be hamstrung.
So in the budget process, there was a schedule that I prepared last year, 2 years ago, that talked about insured assets,
Right.
total assets.
That's a big improvement.
This was one component that if there was a catastrophe, obviously the board would have numerous resources, of which this is one.
Okay.
Yeah.
You know, a couple of other observations, you know, I think the reason that other revenue is involved is the $1 million for litigation.
Yeah.
Okay, what you might consider doing to address the question people have is take your one for the budget and split it between the two, and then put footnotes. Because then what you're talking about and the verbiage will immediately follow through. Because we're going.
Just so you know, this won't exist going forward.
No, I know,
Yeah.
but just for the purposes of that,
Right.
I think if you were to split it and then put it after, I know you're trying to get back to the original presentation. But most people would get that, so I think if you split it with a footnote saying in the budget, it's 1. The other thing is that, you know, I hear what you're saying about the employee, about the healthcare, but employee benefits is actually negative year over year. So if that's headcount, if it's payroll taxes, whatever, I think you might want to add, some clarity around that. So that people don't hear one thing and then talk back and,
So you're talking about actuals year over year?
like very much.
Right.
So, but I don't think it's headcount, it's payroll taxes or something else, but, you know, it's good for making progress, healthcare benefits, but it doesn't seem to be what we're trying.
I'll take a look.
Yeah. And then the other thing is, on that, how are the auditors going to test your incur but not receive, rule? Because it goes to that why I've been bit by that in the past, is the auditors all the hindsight.
I mean, it's an estimate, they'll probably take, I don't know for a fact, but they'll probably, talk to WellNet and understand the mechanics, so to speak.
Right. I just want that I got bit by that in the past because they do the final check for they issue the longest check for subsequent, events.
Yep.
And they have the benefit of hindsight, whereas you don't. So I don't know what the idea part is.
Right, but the challenge of that is we probably won't get a full report on that until like 3, 4 months, 5 months after.
Agreed, but
And they'll close that.
I'm just saying, watch out. Like,
I got you.
bit by that.
I got you.
Thank you.
Anybody? Anything else? All right, Thank you, good discussion. Thanks to the subcommittee. Thank you, Michael. Can't tell if he's still there or not. And to the rest, to Debbie and David as well. All right.
Thanks, everyone.
Motion to adjourn? Second? We are adjourned. Thanks very much.